Hey everybody, how's it going? My name is Zach Richmond of the Richmond Realty Group RE, Woodlands, and Spring. I'm here with my brother.
And my name is Jon Sanderson with PrimeLending, local mortgage company.
That's right. So in the past, John and I have done market updates, and with 2020 being total insanity.
Right, now we are at 2022, let's start fresh.
Yeah, and today, I don't know when the video is coming out, but January 26th is today, and we got a lot of news that came out from the Fed and the Treasury about what's going to be happening in the future. So we thought we should give you guys an update about what we saw, what we're going to see, and who knows, right?
That's exactly right. This is a perfect day to be doing this video because the Fed just came out with their announcement. So
that's right. So at first, before we get into that, I do want to talk about 2021. So 2021 was an absolutely wild year. In our market, it was hotter than anything you can imagine. All of Texas, Florida, Tennessee, all those places grew substantially with people moving from out of state here locally. So it's unique. Normally we see economic moves. A lot of people were doing it for quality of life. So that was different also. A lot of large institutions put a lot of money behind the Zillows, the Open Doors, all these companies that bought homes, the investor. But we had a moratorium of foreclosures and evictions, so nobody was getting removed from their house. So where did they go? The retail market that you and I buy the homes we live in out of. So there was no investment properties for them to put their dollars, but per their agreements, they had to deploy all this money. So what happened? It put a lot of pressure on the lower price points where all of our clients that were first-time home buyers were competing versus cash versus all these large investors. And then to size it all up, at the end of the year, they all reported that they lost hundreds of millions of dollars and that they're exiting the business.
Exactly, Zillow did that.
Yeah, I mean, it was, yeah, I mean, we all knew it from our perspective, but and it's hard for your clients that are trying to move in to their first home and compete against Wall Street cash.
Exactly.
So they're out of it, so that should change. The moratorium for foreclosures and evictions ended, so we'll see some of that come, but it's been different. There's been a lot of equity. The standards for mortgages have increased.
Yes, actually the standards for mortgages really transitioned in 2008, excuse me, sorry, went back. And the guidelines have gotten a little bit more rigorous. And so one of the questions I get a lot, if I can transition real quickly,
yeah, for sure,
is do I foresee a housing bubble? On the mortgage side, no, I really don't see a housing bubble. And the reason that I don't is that because the underwriting guidelines are so strict. Not saying that that's not to discourage you. It's just that the underwriting guidelines have certain restrictions on verifying income and assets and things like that. We're not doing any of those loans that we did prior to 2008, where we just took your word for how much income you made or what you had for assets. So all of these mortgages that we're writing today are very well backed.
I know,
they're underwritten, and
so
I don't see a lot of these people running into issues on making their mortgage payment.
Yeah, it's so interesting. I mean, I've looked at this stuff all the time. 0% down stated income. That's what 2008 was.
That's
now,
what it was.
Yeah, it's 20% down, 10% down. People are finding it from savings. They're getting gifts from family members. The loans that are being made today are not bad loans like they were in the past. So that was wild. And
it was.
You guys dealt with a lot of forbearance issues in 2020.
In 2020, yes. Yeah. And now that's pretty much gone. So we're just looking at home prices that are skyrocketing.
Yeah.
That's what we're seeing.
So the statistic we saw that came out from Black Knight, it's a great it's a statistics company, but they show that there was 5 million homes that went into forbearance between June of 2020 to December 31st, 2021, and they gave the status up on that. So currently there's only about 780,000 in forbearance, but this is what's crazy. Everybody was waiting for this. A lot of people we talked to, I just want to wait to buy a house when prices go down. Well, because equity and home prices, like you said, went up, there was only 1.3% of homes of that went into short sale or foreclosure.
Right. Much less than we thought.
Much less.
Much less.
So a lot of people could sell their home if they took a forbearance and take the cash that they made and pay off the debt. So that foreclosure and short sale didn't happen.
Right.
So with the moratorium of no evictions, foreclosures, all the people that were in forbearance selling their homes for profit and not putting them in there, we saw a unique market where wholesalers, investors came to your market. So
exactly.
That was wild. That's also what pushed up prices this last year.
Exactly.
So what about you guys? There was the refinance boom.
We had a refinance boom in 2020, and it slowed down towards the end of 2021, and it's pretty much come to a screeching halt at the beginning of this year, just because of interest rates.
Yeah, exactly. So interest rates came up a little bit so far this year, and we expect them to go up a little bit more. So tell them about what was going on with the Fed today.
Timing, like I said, is perfect. The Fed actually just came out with their announcement just before filming our interview here, and they have announced what a lot of people have already thought, that interest rates are going to go up, that the Fed is going to increase rates, and they did say that they're going to increase rates as of March. So it's expected. The interesting thing, though, is that most of the time the mortgage-backed security market, which has the biggest influence on mortgage rates, and the 10-year Treasury, which is another gauge that we look at, had already priced this improvement, or this increase, into the market, but the market is actually reacting opposite of what we thought. Rates are continuing to go up today. So it'd be interesting to see what happens. Typically what does happen after the Fed makes an announcement like that is that it's a knee-jerk reaction. The market moves in a crazy way, and then in the next couple of days we'll start to see things settle down, and that's what I would expect that we'll see.
Exactly. I mean, we all knew this was coming. They've been announcing it since like the second half of last year, so this is not new news. I think the only shock we had is that we expected them to raise rates in December, but they didn't.
Exactly.
So, the fact that they're being raised in March was one of the things they talked about. So we've all been expecting this, and that should hopefully combat some inflation, which will also actually hurt the borrowing power for you guys out there. So if rates go up, it means you lose your potential for loan, which means you have to look at maybe getting a less house without changing anything at all. No salaries, no expenses, none of that stuff. No debt.
But hopefully with the inflation, your salaries do go up to compensate for that. So,
well, I mean, that's the thing. So like, especially in our market, like everybody asks us like, hey, what's going to happen? Like, are prices going to fall? Okay, so let's break this down a little bit, because this is one of the things we talk about, and I actually don't mind talking about it. I think it's good to hear. So we've gotten so accustomed to low rates over the last 10 years.
Yeah, we've gotten addicted to it.
Yep, and we've been in the seller's market since oil was at $120 a barrel. So we haven't been out of the seller's market. So what is a normal market? A normal market is when there's 6 months of inventory. That's equilibrium. That means if no new homes were put on the market tomorrow, like no more homes, all the inventory we have today will take 6 months to sell out every single home.
And I dare to ask, where are we right now?
Well,
because it's probably pretty low.
Yeah, so when oil dropped down from 120 to 30, we were at 4 months supply, which is a seller's market, so it was really hot. Still, even then. Now we are at 0.5 months inventory, all price points.
That's incredible.
I mean,
absolutely incredible. I've never seen that.
Never. I mean, we are at, so that means as of today, we shut down all listings, no more listings came on the market in 2 weeks in the Woodlands, we'd sell out of every home. So that's incredible. So let's say the market does slow down. Let's say rates do go up some, and we're still gonna probably be at like 3-4 months supply, which is still a seller's market. That's still a good market. So even if things slow down, we're still battling how crazy it is out there.
Right.
And a lot of people are still moving here. We're working with a bunch of people that are still moving from the East Coast, the West Coast, and up north. I mean, it is very common still for most, like 1 out of 3 of our calls are still somebody inquiring about moving here. So I don't know if this is gonna slow down, even if things do slow down.
Yeah, I don't see it slowing down. Rates, even though they are going up,
Yeah.
we're still at historic lows. I've been in the business for 27 years.
Yeah.
And in my 27 years, it's, the majority of it has been 5% plus.
Right.
And that was always still very good markets during those times. And we're still well below 5%.
Yeah, I mean, it's crazy. I mean, they're estimating, from what I saw, they were estimating that rates would go up to like 3.5, 3.6. Okay, well, that's where we were like 2 years ago, 1 year ago.
Exactly.
So it's like, we got so used to seeing such crazy low rates that we forgot that even those low rates are still fantastic rates.
They are. We did get addicted to it.
Yeah, right.
We did get addicted to it.
But this should help out with the whole global macro world and all that stuff. So some positive news. So what's happening? How will our market be affected too? Well, right now, what we do know is that rig counts are up. Oil is up. So as far as we're talking about hyper-local, Houston, the Woodlands, at this point in time last year, we only had like I think it was like 400 rigs or something like that, 390 rigs active going. We have 604 a year later at this point in time.
Which is excellent.
It is excellent. So, we're at 600 rigs right now that are active and going. So that means that oil and gas, which is our big economy here that supports a lot of things, is picking back up. 226 new rigs as of this point in time, 12 months ago.
That's a 50% increase. That's good.
It is. So,
Very good.
but where were we before that? So January 2020, it's 791 rigs. Before COVID, nobody's traveled, everybody shut down. And so we're getting back to where we were at that hot economy back in 2020. So things are still growing and progressing here. So I can only imagine that growth from a social and macro and even economic here, Texas will be continually be hot. So.
I agree. It's always been a great market in Houston, and it's diversifying even. So oil is still a very good piece of the economy and a very strong piece of the economy. But the good thing that I've seen is there's been a lot of diversification.
I mean, medical is now our
Medical
largest.
is huge.
Medical is now our largest employer in the Woodlands area. I mean, that's something that was different. 2019 and before, it was always oil and gas.
Right.
So medical beat that out in 2019 for being our #1 employer of jobs.
Amazing how quickly that grew.
I mean, if you look
Just
out
within-
here, over
Within the
here,
last 10 years, it's been just exploded.
nuts. I mean, over here we have 5 major hospitals and they're all going through expansion and growth. And there's a bunch of private practices that are growing. We're getting manufactured medical here. I mean, we're doing very well. We're very fortunate and blessed to be in our local community. So,
Without question.
will things slow down, John?
Things will slow down in our industry from a refinance standpoint for sure, because rates are higher and the justification may not be there. But again, rates are still at historic lows over the 27 years I've been doing it.
Right.
And so it's still a great time. You get a 3.5 or a 4% interest rate. That's fantastic. Absolutely fantastic. And you still have very good buying power.
Yeah, I know. My parents told me how their first mortgage was 16%.
I heard the
and they
exact
feel like
same
they got a
thing.
steal. Yeah,
That's right. I know. My mom, same thing. She told me about 16% interest rate
Yeah.
was the interest rate on her first house.
So anyways, will the market slow down? Yes. But will it be enough to make a direct impact? No. Redfin and Zillow, from a national perspective, are estimating that prices will still go up in 2022. So who knows what could happen? We don't have the crystal ball. Will interest rates affect it that significantly? Will it be something else on a major global economic scale that we don't know? Potentially, but here in Texas and especially Houston, we're pretty insulated. So we'll be able to absorb a lot and things should still be fine. So if you have questions about what to do next, if you should stay, if you should go, call one of us. We'll be happy to sit down and just visit with y'all about next steps.
Agreed. Always have insight on the market too. So if you have any questions about interest rates and where they're going in the near term, by all means, just give me a shout.
Yeah,
I'm happy to have that discussion.
I'm a total data nerd, so if you want to know what's happening, holler up. We can talk about it. We can have a good time.
And I'm a CNBC nerd. I watch the Business Channel all day, so it's kind of a sad situation, but it keeps me informed for my customers.
Yeah.
So that's the good thing.
Hey guys, if you like this, you have any comments, questions, put them in the comment section below. Like this, share this. We're happy to talk with y'all. We're happy to visit. I'm Zach Richmond from the Richmond Realty Group RE of Woodlands and Spring.
Jon Sanderson, PrimeLending, short and sweet.
Stay classy.
Take care.